What CapEx is and why it matters to the value of your business. Hi, this is Josh Horn of Horn Valuation. I help owners build, value, and sell their business. What does CapEx mean? Capital Expenditures, also known as fixed asset additions. We're talking about machinery, equipment, could be trucks, could be technology, assets that generally cost more to put into your business that are expected to last at least a year. Why does it matter? Well, I've seen situations where the fixed asset additions are too low. I've seen situations where they're too high. We're going to go through a quick example today, and I'm going to show you why this matters and what you can do to deal with CapEx and put your business in the best position to grow its value going forward. We're going to look at the balance sheet of a business right here, and I really want you to focus on one line item in particular, which I'm going to highlight in just a second. Well, let's just take a quick look at this business and see how it's doing. This business is earning a profit, and it has cash on the books, and it has no debt. And so if you were just taking a quick glance at this business, you'd say, hey, it's profitable, it has positive equity, no debt, there's cash in the bank. Generally a pretty good thing, right? Let's take a look at the line on this business, which is called fixed assets, or in this case, fixed assets net of depreciation. And depreciation is an allocation of the expense of that fixed asset over a period of time. So if we look at this business right here, we'll notice that the net fixed asset additions over the last 3 cycles are 0. Is that a problem or not? Well, it depends on the business, but generally that's going to be something I'm going to pay attention to, because I'm going to wonder, why didn't the business put some money into some fixed assets over time? So let's say I determine after analysis that this business should be spending approximately $20,000 a year on CapEx. Remember that number, 20,000. It's going to be important in just a minute. Now let's go through a quick estimate of what this business might be valued at if we just forgot about the CapEx and just pretended like it wasn't an issue. Now let's take a look at the bottom of this page. And let's assume we just use the average net income of this business. We forgot about the CapEx. We didn't use it in our calculation estimating the value of this business, and we came up with a rough value of $424,000. In fact, it was very important. Now I want to alert your eyes to something else on this page that tends to happen over time when the CapEx investments aren't made. Take a look at the net income year over year. Notice that it's starting to drop. Pretty common, because what can happen often is that if those cap investments aren't made, you're going to start to spend more money on repairs and people and things to fix that stuff that's starting to break down. So let's scroll back down here. If we incorporate that $20,000 CapEx investment into the value of this business, we determine that the actual value is closer to $336,000, an overestimate of $88,000. Unfortunately, it could get worse than this, because sometimes if the CapEx investment is poor enough, you'll actually run people off too. Things will really just start to fall apart at the seams. So I'm going to go through some things you need to think about with regard to your CapEx investments. So what should you do? Don't overspend or underspend. And we're going to talk about how to handle that in just a moment. The example I showed you today was clearly an underspend. That business did not invest in CapEx. It was headed for trouble, because they're going to face a situation where since they didn't invest over a period of years, they're going to get hit all at once, and they're going to have to invest 3, 4, 5 years worth of CapEx, which is going to chew up their cash, or it's going to force them to borrow money to fix that hole they've dug. I've also seen situations where companies spend too much. Often it's driven by tax motivations. So you don't want to be in a situation where you buy a bunch of equipment, vehicles, machines, whatever it is, and they sit idle and they don't increase your cash flows and or reduce the risk of the business. How can you prevent this from happening? Have a plan. It doesn't have to be complicated, but come up with a 5 to 7 year plan of how you're going to add or delete fixed assets. There are going to be some things that are just simply going to start to break over time. What year do you estimate that's going to happen? When are you going to replace that so that you stay on schedule? Finally, put yourself in the shoes of a potential buyer. They're going to go out there and they're going to look at the trucks, they're going to look at the machines, they're going to kick the tires, and they're going to say, hey, this either looks great or hey, they're not spending enough, and that's going to come out of my pocket. Don't expect them not to catch this in the due diligence of buying your business. They're going to look at these things and they're going to notice through the financials and through the eye test whether or not you're spending enough on CapEx. And it will come out as a haircut in the value of your business, as I showed you in the spreadsheet example. This is Josh Horn, CPA of Horn Valuation. These are some of the ways you can stay on top of CapEx and how it affects the value of your business. Have a great day. Bye.